Hello, everyone. We have had a lot of conversations recently about buying and selling individual stocks, especially since this pandemic has started and people have had more time on their hands. So over the past few months, I've been in several conversations, usually at a Zoom happy hour or other thing like that, which has suddenly turned to talk about day trading. So in very passionate voices, friends, both old and new, would talk about the hot stocks that they were buying and selling and trading, or the ones that they wish that they had traded more often than not. So the voices would get louder and louder when they would talk about how much money they had made when they bought a stock at $12 and sold it at 25 or 100, and typically the bigger the profit, the louder the voices would get. So here's the warning. I am usually a buzzkill in those conversations, and I am going to tell you why today. So let's start with a quick story. Some of you guys might be familiar with Barstool Sports and the founder, Dave Portnoy. He is famous for not only his sports analytics, but also his pizza reviews. He started to get into day trading during the pandemic because there were no sports to bet on. And after he had done a few trades, he threw shade at legendary investor Warren Buffett when he said, and I quote, "I am sure Warren Buffett is a great guy, but when it comes to stocks, he is washed up. I'm the captain now." All right, so this quote specifically came after Portnoy, who now has deemed himself a Davy Day Trader. He started trading in the stock market. He had lost up to $700,000 somewhere in that first month. And since then, though, has made some pretty big trades that he claims have made him big bucks. Disclaimer, the exact figures are elusive and I have not been able to pin them down. So if you have found them, please let me know. So this begs the question, is Portnoy right with his new day trading strategies over long-term investment guru Warren Buffett? Well, let's dig in. So to answer this question, we need to look at three different types of investments because technically what Portnoy is doing is very different from what Warren Buffett is doing. So we're going to start with three different investments just to sort of ground ourselves in that. The first one are called growth stocks. The second one are called core holdings, and the third type of investment is called a value stock. So let's start with growth stocks. Growth stocks, technically, the definition from Investopedia says it is a stock in a company where the market, it's you and I, predicts that the company will grow at a significantly above average rate. So in layman's terms, that just means a hot company that people are talking about. So these days, think Amazon, think Zoom, think Tesla. Yeah, Tesla's been a big one lately, amongst a slew of others, but those are sort of the three that come to mind. So critical attributes of a growth stock, we're going to talk about four. Number one, a growth stock may or may not have actual earnings or profits yet. So sometimes when companies are just starting up, they're burning through capital that they've raised in rounds of funding, but they might not have profits. So that's very typical amongst these growth stocks. Number two, speculators tend to trade these stocks more frequently. So it's the opposite of the buy and hold. So you might see people buying them one day, selling them the next, or even later on that same day. Growth stocks typically do not pay what we call a dividend. A dividend is just a payment you receive as being the owner of a stock from a company. We'll talk more about that in a second. And then the last thing is growth stocks trade at a very high price to earnings ratio. And I'll explain more about that in a second. So let's take a stock that has become the talk of the town lately, Zoom. If I had $1 for every time someone said, I wish I had bought Zoom before the pandemic, I would be a very wealthy lady. And to be clear on this, I love Zoom. I use Zoom on an almost daily basis, especially during these COVID times. I think it makes life better and easier and connects you to people that you might not be able to see otherwise. So I am not picking on Zoom in all of this, but it is just an example, a prime example of a growth stock. Okay, so I mentioned price to earnings ratio earlier. Let's dive into that for a second. So a price to earnings ratio is one of many metrics that we use to help determine the value of a company. So typically we like to look at multiple metrics. We don't just like to pick one, but for the sake of this example, we'll just go with this one. So simply put, the price to earnings ratio is just that. It is the price of the stock divided by the earnings per share. So the most important thing to keep in mind is that the average PE ratio is 17. Okay, 17, that's it. So let's talk this through, let's hash it out a little bit. So let's take company ABC. Company ABC is earning $2 a year per share. So if they were earning $2 per year per share and the average ratio is 17, that price of the stock would be $34. 2 times 17 equals 34. If it was earning $2 per share but only trading at 5 times earnings, then it would be trading at $10. And that is, 5 is less than 17, so that is under the average. When we're talking about growth stocks, though, we're talking about it trading an above average rate. So if it was trading something, let's call it 25 times earnings. So it's making $2, but it's trading it's trading at 25 times earnings, then that means the stock would be trading at $50. The higher the multiple, the more a company is pushed into the growth stock territory. So back to Zoom, right? So Zoom was founded in 2011, but is just now turning profitable with their earnings. So it turned profitable, which is great. Analysts predict that Zoom will earn $1.55 per share in 2021. So we're looking a year out now. If Zoom were to trade at an average multiple of 17, that means their stock would trade around $26.35, $26.35, because 17 times $1.55, $26.35. Drum roll. Their stock is trading at around $250 today. So that means the price to earnings ratio is at 160 times earnings. So this means investors are paying a premium for this. There are no discounts. You are expecting, if you are investing in the stock, you are expecting the earnings to go higher and higher and higher. That means there are very high expectations for this stock. If anything that goes wrong, though, and these expectations are not met, then the earnings could drop very sharply. At some point, the stock will revert back to its mean. So to stay at $250 a share, either earnings have to increase very significantly, or you'll see the price revert closer to that mean. So investing at these lofty premiums is risky, which a lot of people don't realize, because they're not supported by the actual earnings of the company currently. So if you're a long-term investor, typically you tend to stay away from things that are trading at a premium. If you are a short-term investor, like a day trader, then you have to buy and sell your trades at the perfect time in order to really capture a profit. Because sometimes if news comes out and you blink, the stock has fallen from $250 back down to $50. That's what we see. All right, so those are growth stocks, or what Davey Day Trader is buying. The second thing we won't spend a ton of time on is just a core holding, just to contrast this to a growth stock. So a core holding should actually be the central investments of a long-term portfolio. So core holdings should be investments that have a long history of reliable and consistent earnings, as well as returns for the investor. What Davey Day Trader mentions, but it's very, very brief, is that he actually has an entire portfolio that he is not touching during this time that are full of these core investments. I'm assuming they're full of core investments. So he is already got that part of his long-term plan set. I think that's really important to know, because I think it can be misconstrued that he is putting all of his money in these short-term trades, which is not accurate. Okay, so core holdings, just to go back to that, can be anything from stocks to bonds to mutual funds. An example would be holding an S&P 500 index fund, because we've seen how that tracks the market for an extended period of time. To keep our examples consistent, though, let's use an example from a stock portfolio. So in a stock portfolio, an example of a core holding could be something like Coca-Cola, right? Coke has been around for over a century, and it's operated consistently with profits. They have a very sound balance sheet. They've made it through the pandemic, and they also have a nice dividend. So they pay you 3 to 4% just for owning that stock. Currently, their price to earnings ratio is around 22. So again, these are just investments that you want to have in your portfolio. They are reliable, they are consistent. There might be some wavering if something drastic like COVID happens, but typically the prices are supported by the fundamentals of the company. Which brings us to the last kind of stock, or last type of investment. We are going to dive into value investments. So value investments, contrasting this to Portnoy, value investments are where Warren Buffett lives. The people that buy value investments are the bargain hunters of the world, who are looking for the next great deal and are willing to put in some time and energy to sniff it out. So key attributes of a value stock or a value investment. So value investments are typically out of favor in the general market. So you're not going to hear people sitting around at cocktail hours or Zoom happy hours talking about the companies that have sort of been tossed to the side, left behind, haven't come out with anything new in a few years. Or they might be facing some serious internal issues. So think about Boeing after the 737 MAX tragedy, right? Like that, really, the company really took a hit, and they're still, in fact, recovering from all of this. Compound that with COVID, and they've got their work cut out for them right now. So the last thing is that stock tends to trade at a lower price to earnings ratio than 17. So typically we've seen these trades somewhere between, at the lowest, we've seen 4, 5, 6, sometimes 10 times earnings, sometimes 12. Let's look at a value stock to figure out why anyone would ever want to buy these, right? So no one's talking about them. They've sort of been tossed aside. They might be having issues. Why would you invest in something like this? So let's take a value stock from 2015. We'll look at the company Advanced Micro Devices, or AMD is their ticker. At the end of 2015, AMD was trading for $2.75 per share. Intel was the big name in the game, and Intel had just developed a new chip processor that crushed all of the competition, including AMD. So the fundamentals, though, were very interesting for AMD during this time, despite their unfavorability in the market. So this will get a little technical, but I'm going to do my best to break it down. If not, if you don't want to listen to this part, then just remember that AMD was a value stock back in 2015. So we're going to look at two metrics real quick. The first was the price to earnings ratio. So here's the tricky part. AMD had profits in 2013 and 14. They were a profitable company, but they actually lost money in 2015. So when a company goes from profits to losses, their stock will always drop. I think that's pretty much without exception, but if anyone knows of one, let me know. So in this case, the PE ratio becomes pretty meaningless because there's no ratio, it's 0. But if you look at the temporary losses and you can forecast more normalized earnings, then the price to earnings ratio would show that it was pretty undervalued. Contrast this, though, to a company that has never made profit. So if we think about some of the big tech companies that are coming out right now, that again, they did seed funding, they gathered capital, and now they're sort of burning through that capital before they have profits. Those are two different things. One was a company that was profitable, that is not profitable at a current moment in time. The other still has yet to prove its profitability. So that's a key difference to remember. So the second thing we're going to look at is, so if that doesn't work, you have to go somewhere else, right? Like you have to figure out what are some other metrics that we can look at. So the second one we'll look at, for the sake of this example, is the market capitalization to revenue ratios. So market cap just means the price of the share multiplied by the number of shares outstanding. So for this example, the price of the share was around $2.75 at one point, and they have a little over a billion or billion plus shares outstanding. So that means the market cap came in just under $4 billion. So we like to look at the market cap to revenue. So the market cap was, again, $4 billion. The revenue was around $4 billion in 2015-16, maybe a little bit under, which means the market cap to revenue ratio was around 1-to-1, which is under the average of around 2 or 3-to-1. So this data was pointing us to show that AMD was, in fact, a value stock. Now, the important thing with AMD, we now have 5 years to look back on and see what happened. Since 2015, AMD got a new CEO, and they've had several years of increasing revenue. They also ended up creating a chip processor that outpaced the one from Intel. I'm not even going to get into technical details, but apparently they just crushed it. So if we look back, if you had bought 1,000 shares of AMD back at $275 a share, your cost basis would be around $2,750. The stock price exploded over the last few years, around $75. So the value of your stock is now $75,000, or a profit of, on paper, $72,250. Okay, so will it stay this way? So what do you do with a stock like that when a value stock suddenly becomes a growth stock? Well, most likely the PE ratio is it is exploded, so it is actually way above 17 now. It's around 160. But the earnings have been growing, and the chance that it will go back down to a $2.75 stock are very slim to none. So in a case like this, we might recommend to sell a little bit to lock in your profits, but it's continuing to increase and increase and increase right now. So that's an example of how a value stock can actually turn into great wealth over time, if you just have the patience and the timeline to do it. All right, so let's go back to Portnoy for a minute. He is now the self-proclaimed leader of the day trading army. He has over 1.6 million followers on Twitter, and he's encouraged new investors to jump into the stock game with his engaging and very, very opinionated personality. And people have jumped on board. In fact, so much that platforms like Robinhood garnered, I think the New York Times said it was almost 3 million new investors in the first 4 months of this year. Once investors get on the platform, it is so easy to make these trades. So first, there's no fees for trades. There used to be fees to trade, which deterred some people from making frequent trades, but now there's none. You can trade as much as you want without a cost on a lot of the different investment options. They also have set it up so it's like any other social media app. They send you push notifications. You can one-click your way into some of the most complex investments on the market. So what we typically see with day traders is this, though. And so this is the word of caution if you're following someone like Dave Portnoy. What we typically see with day trading is that some day traders get lucky and place a few profitable trades. This is especially true if you start when the market is going up like it was in April so quickly. The more profit that people tend to make in the beginning, though, the more they tend to put on the line and the more risky they make their trades. So eventually what happens is the ones that get lucky will take their profits and they will walk away, which we all know how hard that is. And the ones that are unlucky will mistime a buy or a sell, or they'll put their money in something very complex that they might or might not fully understand the risks of. And then they end up losing everything that they started with plus some. So that's the word of caution right now. So, and also just to remember that Dave Portnoy had in his entire investment portfolio out of this that he was not touching. This was more of a hobby. This was not what he was banking on for his future or for anything along those lines. So in conclusion, who was right, Dave Portnoy or Warren Buffett? So investing is what Warren Buffett has been doing for decades at Berkshire Hathaway. As of July 2020, Buffett was worth $71.8 billion. That's right, $1 billion. And he made most of that money buying companies that were considered value investments. Think Geico and Dairy Queen years and years ago. So the difference is this. With value stocks or entire companies in Buffett's case, the investor isn't looking to make a quick profit. But over time, as the market becomes more favorable to the company and the company's stock price or their revenues continue to increase, you can see massive gains. So in something like an AMD example, there's very little downside. If you invest $1,000, or if you buy 1,000 shares and you invest $2,700 in your long-term portfolio, the risk is that you would lose that capital, right? That first capital. However, what we've seen is over time, if the companies turn around, if they start making money, which a lot do, not all, but a lot do, then you can make massive profits on the companies that tended to be out of favor and sort of cast aside. So the bottom line is we advocate adding a few value investments to your core holdings, as these holdings have smaller downside, but virtually unlimited upside if you have patience and time. This could take years, or it could even take decades, and it doesn't happen every time, but the payout can create real wealth.